Financial. And we're just wanting to stop back in as a follow-up to our conversation we had at our last quarterly meeting about recommending a couple changes. Two things essentially we want to talk about. One is, as the account, as the pension account continues to grow through the contributions from the county as well as just growth in the investment markets itself, we want to kind of continue to further diversify that a little bit more, and Mike's going to talk about that and some of the paperwork that he handed out there with that. And then the second thing is we have a recommendation for one of the managers that we've been using for a number of years called London Company, which manages small company stocks primarily. We'd like to make a recommendation that we move from them to another manager. Just to give you an idea, they currently have under their supervision $2,992,734 is what they have, and that represents about 2.5%. They're the smallest manager that we have, but that represents about 2.5% of the assets. Decisions like this, we don't make changes often, but we gather research from our back office. We have a research department that looks at managers. Mike does analytical work, I do as well. And there's different things that we look at. We look at personnel turnover at the management group itself, whether they're out of alignment with their portfolio characteristics, obviously investment performance, which is what most people look at, risk analysis, which Mike's going to again address that some, cash flows, whether money is going in or out of the management group, manager tenure. So there's a laundry list of actually about 12 or 15 different things, different points that we try to look at before we make a decision like this. So with that, I'll just let you kind of share what the recommendations are, I guess.
Yeah, real simple. The London Company had been having some underperformance, as well as in an effort, I think, to get caught up, took on more additional risk. And that's something in our management of the pension plan here for the county that we always look at. You know, we're trying to minimize risk and getting reasonable return. We're not always trying to get the outperformance, significant outperformance. We want to get the best performance we can, but take on reasonable risk associated with that. So we feel at this time it's time to make a change, and what we're recommending is the one at the top that says Nuveen Asset Management for that replacement. They've been around for a long time. This particular portfolio was founded in 1989, so they have a pretty good track record. I'm not going to go through this whole report, but I will highlight a couple of numbers that we look at in some of our analytics. Number one is the alpha there on the left-hand side. The alpha would be the excess return that a manager gets over and above their benchmark. And for the last 5 years, they've averaged 4.14% over and above, which is a good alpha number. So that stands out as far as when we're evaluating managers for this replacement. Two other numbers that we look at, standard deviation. Standard deviation is a simple measurement of risk. How much risk are they taking on? In that calculation, you want to look for a smaller number. So the smaller standard deviation, the less risk you're taking on. And you can see compared to the benchmark, that number is smaller, so that's a good thing. And then the last number I'll point out is the Sharpe ratio. Again, it's another analytical number that we look at. You can think of it as a risk-adjusted return. So that takes into account the return, but also the risk that they're taking on. In that calculation, you want actually a higher number. That means you're taking on less risk in order to get the return that they've been providing. So again, another nice change there in the positive manner. So the following pages behind there, there's page 2 has some historical information, year by year, as well as annualized numbers. I'll just briefly look at the bottom portion of that, because again, this is an area that we really focus on in an effort to manage the county's pension. There's two charts at the bottom, upside capture and downside capture. Upside capture is what are we getting over and above the benchmark return, and you can see both in the 3-year on the left-hand side and the 5-year. That is a positive. We're getting more than the benchmark. That shows you that alpha that I had talked about previously. But most importantly, we're looking at the downside capture. So an example would be if the market was up 10%, their benchmark, they were up 10%, we would expect, based on this downside capture, that they'd be down 6.2%. Okay, so we'd be protecting more on the downside, which is what we're always trying to strive for. So that's our recommendation. I think the numbers support the change. And this looks like it'll be a good move going forward.
Do you want to take these separately?
Yeah, sure.
Okay.
So any questions?
Seek a motion to change the small cap manager.
Second on the recommendation.
It's been moved and seconded that we change managers as represented here. Any questions? All in favor, please indicate by saying aye.
Aye.
Opposed, same sign, so moved.
So this is officially a prison board meeting then, correct?
No, not prison.
I mean, pension board.
Pension
I
board.
got the P part.
Yeah. And then the other page that we want to just take a look at, as Brett had mentioned, you know, the pension plan continues to grow. Basically, two factors. You know, continue to make your annual payments, contributions, I should say, into the plan. That helps. Some of the changes that were made in the past has helped, and we've been fortunate with the market returns. So, with that, sometimes we look at opportunities to continue to diversify as the account grows. So what we're going to recommend in this portion is take about $3 million out of CS McKee equity. That's a large cap growth manager that we've had. There's been some underperformance, nothing yet to raise our eyebrows at, but in talking with the relationship manager, they recognize that as well. But that's part of the reason, but also, again, more diversification. And moving that money over to Legg Mason, okay, Legg Mason large cap growth. Again, we can kind of look at the same numbers. They have a pretty nice alpha number over 5 years of 3.54% annually. Again, that's the excess return that the manager is bringing in over and above what their benchmark is over those 5 years. The standard deviation is marginally lower. It is slightly lower, not significant. But again, I think the Sharpe ratio, again, the higher the number in Sharpe ratio, the better. It means they're taking on less risk, and that's noticeably different. So again, a similar story as Nuveen, again, trying to manage risk with the idea that we can get some upside capture as well. Again, a very similar story. As far as the performance numbers are, they have a good up capture in the 3 and the 5 year on page 2. And then the downside capture, again, they're kind of reducing the amount of downside that they're capturing, which is a positive.
Seek a motion to move those funds to Legg Mason. Any question or a motion?
I'll make a motion to approve the recommendation of the $3 million from the equity to the Legg Mason account.
Second? Is there a second?
I'll second it.
It's been moved and seconded, and we have a question.
Yeah, so how much is McKee going to have left?
Still have around $20,700,000.
After removing it. Okay, thank you. That's one of your larger.
CS McKee, they have the fixed portion, which is our largest account. They manage the fixed income side, but then they also have an equity sleeve as well. So they represent just a little less than half of the overall portfolio. So again, the diversification, I think, becomes important.
It's been moved and seconded. Any further discussion? Hearing none, all in favor, please indicate by saying aye.
Aye.
Opposed, same sign. So moved.
Thank you.
Thank you.